Good afternoon. Good afternoon. Good afternoon. Welcome to today's session. I think today I want to do a lecture on financial reporting. So I think it will be a bonus lecture for those that are sitting financial reporting. I'm going to tackle a very important standard. There's never an exam that you're going to write where you won't find this standard. So it will be very important that you take it very serious and you understand all the tricks of this standard. So the standard that we are going to look at today is IAS 16, International Accounting Standard number 16. So this standard has to look at property, plant, and equipment. So how do you account for property, plant, and equipment? That's what we are going to tackle today. So I invite you to be invested in this lecture. So allow me to share my screen as we dive into this standard. All right. Okay. I guess you're able to see my screen. But now what I want to do is I want to bring that. Okay. Wow, we are in slide mode now. Yeah, so Kelvin Capoto is my name. I'm a tutor from Virtuous Tax Corporate Services. So we do provide accounting, tutorials to students. We do provide financial trainings as well, especially trainings to do with financial statements, how to read financial statement, financial analysis, and all those aspects. So today we are going to deal with IAS 16, property, plant, and equipment. All right. Okay. All right. So the objectives for this lecture is for us to be able to define key terms in this standard. And then we must be able to define what property, plant, and equipment is from a pool of assets. And then we must be able to identify an asset of PPE. Okay, so you must define it first, then what is PPE, and then you need to identify these assets. And then we must be able to measure an asset of PPE. How do we measure an asset of PPE, or how do we recognize it in the statements, in the financial statements? Then lastly, we need to look at, we must be able to account for PPE, and then we'll look at how to derecognize these assets from our accounts. So let's get started. So we are going to look, so this standard, or we are going to look at tangible non-current assets, okay? So PPE is part of the tangible non-current assets. So when you talk about tangible or non-current assets that are tangible, we are talking about those assets that have got a physical, they've got a physical status. You can actually touch them, all right? An example is this laptop. So this laptop is a tangible asset, okay? So it falls under a class called non-current asset. When you look at a building is a tangible asset. So it's an asset that has got a physical substance to it. So those are tangible non-current assets. But when you look at non-current assets, this is the structure. So a non-current asset can either be tangible or a non-current asset can either be tangible or intangible. So in this lecture, I'm going to concentrate on tangible current assets, okay? So the ones that are intangible are addressed by a standard code IAS 38. And then out of the tangible non-current assets, I'm not going to talk about those assets that are accounted for under investment properties, which is IAS 40. There are also other standards that give us guidance in terms of how to account for certain tangible assets that we acquire, for example, through government grants, and those that we acquire through borrowing. Those standards are addressed by those assets are addressed by different standards. So today, the standard that I'm going to concentrate on, or the tangible non-current assets that I'm going to concentrate on, are PPE. PPE, which is addressed by International Accounting Standard number 16. All right. So let's get to work. Let's get to work and look at this subject called property, plant, and equipment. All right. So what is property, plant, and equipment? We have said these are tangible non-current assets held by an entity for more than one accounting period for use in the production or supply of goods and services, or for rental to others, or for administrative purposes. So those assets that are used for more than one accounting period, okay? Those assets that are used for more than one accounting period to be used in the production of goods and services, those that are used for rental to others, and those that can be used for administrative purposes. An example is a building that a company uses for its, like for example, the head office of a certain company. Or you can talk about assets that they use in the production of services. Okay, you can talk of machinery. Machinery is an asset that is used in the production of goods and services. A motor vehicle is another example that can be categorized as an asset of PPE because it is used in the production or in the delivery of a service. For example, when a machinery is used to manufacture products, the marketing and distributing team will use a vehicle to distribute those products to the market, okay? The asset that they are using to distribute those assets to the market is an asset called a motor vehicle. A motor vehicle will be used for more than one accounting period, and as such, it qualifies to be an asset, to be classified as property, plant, and equipment. All right. So IAS 16 does not apply to the following assets. Okay, it does not apply to the following assets. For example, biological assets. Biological assets are catered for by International Accounting Standard number 41. However, you would find that some bearer plants may be accounted for under IAS 16. I think we can look at that. We'll look at how that can be done when we dive into that standard IAS 41. Investment properties. So investment properties are not accounted for under IAS 16. They are accounted for under IAS 40. Then we've got assets held for sale. These are addressed by IFRS 5, okay? Then exploration and evaluation assets. These are addressed by IFRS 6. Then mineral rights, reserves, oil, gas, and other regenerative resources are not, addressed by this standard. So that should be something that you need to look at when we are dealing with assets addressed by IAS 16. Okay. So after looking at the introduction or definition of property, plant, and equipment, I think it is very important for us to familiarize ourselves with some of the definitions that we are going to meet in this standard, excuse me. So these definitions, will be using them more often. So it is very important that you know them because the standard gives us those definitions. So what is a cost? A cost or costs, this is the cash or cash equivalent paid as a consideration for the acquisition or construction of an asset. So the cash that is paid or a consideration transferred for an acquisition of a certain asset is what is referred to as cost. So it's basically the money or the cash that you pay to acquire an asset. That is what cost means. Residual value or residual value. This is the estimated amount at which an asset will be disposed of after its useful life. So when you acquire an asset, you are going to estimate the period or the economical life of this particular asset. You can acquire a motor vehicle and say, okay, we can only use this vehicle for a period of 5 years. And at the end of 5 years, this asset will remain with a value of say 10,000 kwacha. That 10,000 kwacha at the end of the useful life of an asset is what is referred to as the residual value. Okay, so those are some of the terms that we are going to be using. Then we have fair value. So fair value, this is the amount at which an asset or liability can be exchanged in an arm's length transaction between knowledgeable parties in an efficient market. So fair value is basically the amount, okay, the value at which you can transfer an asset from one party to the other. But the only difference here between the fair value and the cost is that in the fair value, you're dealing with, number one, a market that is efficient. So the person that is selling the asset and the person that is buying the asset should have actually information about the market value of this particular asset, okay? So if I have a vehicle and I'm going to sell that vehicle for 150,000 kwacha, it should be determined within that market that, okay, that is the prevailing market value. So even if I transfer to the other person, I'm transferring a fair value. So by its name, this is a fair price at which you can actually sell an asset. Okay, so if you forget about all these market arm's length, just remind yourself about the word fair. So this is a fair price at which you are going to transfer the asset. Okay, so that is the fair value or the market value in short. Then we have the carrying amount. Carrying amount, this is an amount recognized in the financial statements after deducting an accumulated depreciation and accumulated impairment. So when you have the cost, okay, so you've got the cost, and then after using the asset, you are going to calculate what is called depreciation. And after you use the asset, actually, you would find that sometimes the asset may suffer what is called impairment, okay? Now, for you to determine the value at which you are going to carry the asset in the financial books, you need to get the cost, remove any accumulated depreciation and any impairment suffered. The amount that you remain with is what we are referring to as the carrying amount or the carrying value. So this is the amount that you actually incorporate in the financial position, the statement of financial position. I think that's clear. Then what is impairment? So when the fair value or the recoverable amount of an asset is less than its carrying amount, the asset is said to have been impaired. Okay, so remember I talked about the fair value. So the fair value is the fair price or the market value of an asset. Okay, so now when you do a revaluation on that particular asset, and then you realize that the carrying amount actually exceeds its recoverable value. So if a recoverable value is the price that you're going to sell you, or the cost or the price that you're going to sell your asset at that particular day. So if my carrying amount, which is the amount I've recognized that asset in the financial position, exceeds this fair value or the market value, then we are saying this asset has suffered impairment, and as such we must restate the balance. We must restate the carrying amount to its fair value in our books. So that's what we mean by impairment. So that difference between the carrying amount recorded in your book and the current fair value is what is referred to as an impairment loss. Okay. Depreciation is just basically, this is basically the systematic allocation of the depreciable amount of an asset over its useful life. So if you did financial accounting, you remember how to calculate depreciation and should not, belabor on this. So this is basically just wear and tear and allocation that you actually, or some amount that you allocate to wear and tear as you use the assets. Okay. Then we can talk about value in use or entity-specific value. Value in use or entity-specific value. So this is the present value of the expected future cash flows generated by the entity from continuous use of an asset. So the value in use and the entity-specific value are very pronounced in when you start dealing with intangible asset under IAS 38. So that's the So this is the present value of the future cash flow. What happens is this: when you buy an asset, okay, you are going to, you are going to do what we call discounted cash flows. For example, you are going to say, okay, when we buy this particular machinery, it will be able to produce so much units, and these units will translate into these cash flows. So year 1 up to year 5, for example, you are going to put the cash flow. So those cash flows, remember, when you are planning, you're talking about, you are planning now. So you are determining those cash flow based on what you have now, right? But remember, these cash flows have not been realized. So you're looking into the future. So now, to be more realistic, you need now to bring those cash flows into the present terms, or into today's, into present terms. Okay, what would be the 50,000 kwacha in 2025? And then if we discount it to today's value, what will it be? So those are the present value. So the value in use is basically the present values of expected future cash flow, or that's the entity specific value. So that is the value that you're going to derive from the use of that asset. I think I've dealt with the explanation. So when you hear me use some of these words, so some of these jargons, don't get confused. I think I've labored on trying to explain what this means. All right. With that said, let's proceed. So now, when you're dealing with a standard basically looks at 4 things. Any standard that you look at, any accounting standard that you look at actually looks at 4 things. Number 1, you need to talk about the scope. Okay, what is the scope? The scope is what we've covered, the definitions. Okay, that is the scope of a standard. Number 2, we are going to look at the criteria, called the recognition criteria. Okay, number 3, you are going to talk about the initial measurement of an asset. Okay, number 4, you are going to talk about subsequent measurements. So 5 things. You're going to talk about the subsequent measurement of the particular asset. And lastly, you're going to talk about the derecognition of an asset. So 5 things that you should actually put in mind: scope, initial recognition, measurement, subsequent measurement, and derecognition. These 5 things are very important. So whatever standard you are going to look at, just look at these things, okay? So recognition criteria. So the recognition criteria is basically the criteria that is used to identify a certain asset or a certain item to be an asset of PPE, okay? So there are different assets. There are those assets that are accounted for under IAS 40. Then there are also those assets that are accounted for under IAS 16, IAS 38, there's IAS 20, there's IAS 41. So different standards give guidance to how you can actually account for different assets. So recognition criteria is basically the criteria that must be applied to qualify an asset as an item of property, plant, and equipment. I'll repeat that again. Recognition criteria is the criteria that is used to qualify an asset to be an asset of property, plant, and equipment. All right, so the standard guides us to say an item of property, plant, and equipment should and must only be recognized as an asset when the following is met, okay? So an item of property, plant, and equipment should and must only be recognized as an asset when the following is met, okay? So if I buy this laptop, okay? If I buy this laptop, is this laptop an asset or it is going to be an expense? I spent money, remember? So I spent money to get this laptop. And I've reduced my bank account by a certain amount and I bought this laptop. Okay, but when I bought this laptop, how do I then recognize this laptop in my books? I'll recognize it as an asset if it actually meets these 2 criteria. Number 1, it is probable that the future economic benefit associated with the use of that asset will flow directly into the entity. If I get an asset that belongs to another company and come and use it in my business, I just borrow it. There's no lease agreement agreed with that particular company. I just borrow that asset and bring it in my business and use it, okay? you need to determine, are the future economic benefits going to flow to your entity? Most likely, you are going to pay the other company for the use of that particular asset. We are going to deal with those transactions when you start to talk about leases. But what I'm trying to communicate here is that it must be probable. There must be a probability that, okay, when we get this asset, future economic benefit are going to flow into the entity. That is the criteria number one that must be. Number two, the cost of the asset must be measured reliably. So you should be able to attach a cost to that particular asset. If my brother gives me an asset to use in the business and I cannot determine the value, reliably, then it will be difficult for me to actually recognize that particular item as an asset in my books of accounts. So the first thing is it must be probable that the future economic benefit must flow to the entity. To the cost of assets, the cost of that particular asset must be measured reliably. So this is the criteria that must be met. Once this criteria is met, then you'll be able to recognize that particular item as an asset of property, plant, and equipment in the statement of financial position. All right, let's get moving. Excuse me. Let's look at the measurement. Okay, so measurement, what is measurement? So measurement is basically it's basically establishing the value that you must take to your financial statements, okay? When you bring an asset into your company, remember you must have spent some money to acquire that particular property. But now, at what value are you going to carry this particular asset at, okay? At what value are you going to record? So you are basically trying to quantify or add an amount to this particular asset. You must add a cost to this particular asset. So that's what measurement actually means. So the standard gives us the following guidance. So an item of property, plant, and equipment must be measured initially at its cost, okay? So you must measure an item of property, plant, and equipment at its cost. So when you buy an asset for the first time, first you must measure it at its costs. So now there's guidance, there's some guidance that have been given here. So the cost includes the following. So the cost of acquisition, or the cost that must be included or capitalized. Okay, that's the term. That must be capitalized in the statement of financial position is your purchase cost. So that's the purchase price less discount or trade discounts that have been given. And I want to belabor on this point, okay? So when you go to buy an asset and then they give you a trade discount, a trade discount is where you say, okay, you are going to buy a motor vehicle. This motor vehicle is going to cost you 170,000 kwacha. And then your supplier says, okay, Mr. Kapotwe, instead of giving you this vehicle at 170,000 kwacha, I'm going to give it to you at 150. Okay, so I've been given a trade discount, and as such, I'm going to acquire that asset at what? 150. So that 150 is the costless trade discount. Now, this is different with early settlements, okay? So if, for example, I get an asset and I get an asset from the supplier and they tell me to say, okay, this asset, Mr. Kapotwe, is going at 170,000 kwacha. All right. And then what I do is I make a part payment to that particular asset. Then they give me, say, 1 month to clear that asset. So if I pay within 1 month, I'm going to pay 170. All right. If I pay after, say I pay, say within that month, I'm going to pay 170,000 kwacha. If I pay, for example, if they give me to say you need to pay by 30th, and then I pay on the 30th of January, the balance on that particular asset, I'm going to pay 170. But they tell me to say, Mr. Kapotwe, if you pay this asset by the 15th, okay, if you pay it early, say you pay it earlier than the 31st of January, then you're going to qualify for a settlement discount of 10,000 kwacha, and then you're going to get this asset at 160. If that is the case, that settlement discount does not qualify as a cost. Okay, that settlement does not qualify as a cost. So I'm not going to less it. I'll actually quantify that asset at 170 and not 160, even if I was given a 10,000 settlement discount. So the only discount that qualifies to be less is the trade discount. I hope I'm clear. Then to the purchase cost, you are going to add import duties, okay? So these are import duties that are direct to the cost, all right? Again, here you must, so if you pay any non-refundable taxes, so the only thing that qualify in this statement is your price plus any import duties plus non-refundable taxes paid. So if you pay any taxes at the acquisition or at the border when you're importing an item of property, plant, and equipment, and then you pay import duty, and then you pay recoverable VAT, for example. If there is recoverable VAT does not qualify to be part of the cost, okay? So that recoverable VAT, you must expense it somewhere. You're not going to capitalize it at the cost. The only VAT that is going to be accepted is non-recoverable or non-refundable VAT, if there is something like that. Then that will be qualified and you're going to capitalize it as a cost relating to that particular asset. And then you're saying any cost incurred directly in bringing the asset to its useful state. For example, architect fees, all right? Architect fees, handling costs, site preparation costs. Those are direct. Those are direct costs because you are supposed to incur this cost in order for this particular asset to do what? To be put into use. I'll give you an example. When you buy a vehicle and you have to engage an agent to help you with clearing and then bring that particular asset into your business for it to be used for the first time, the fee that you pay your driver or the agent to help you clear at the border and to transport that vehicle into your company must be capitalized. Those are some of the things that you're talking about, handling costs, okay? Those costs must be capitalized and not expensed. However, when the vehicle has been brought into your company and it is ready for use, and then you incur an expense, for example, to repair tires or to repair one tire, okay? That asset is able to be used 2 days after that you've used that asset. And then you say, okay, you know what? The tires are okay, but I think we need to put new tires so that this vehicle can work efficiently. You replace those. Those are considered as repairs, okay? Those are considered as repairs, and as such, you are going to expense that cost and are not going to capitalize it. It will be different if, for example, you bring that vehicle into your premises and you realize that it can't move because it has some bearing problems and that asset has not been used before. Then maybe at that particular point, the cost that you're going to incur to do that, you might have to capitalize them. Then lastly, part of the cost, okay? So part of the cost are unavoidable costs of dismantling. All right, unavoidable costs of dismantling. So here we are told, so the present values of these costs must be capitalized with an equivalent liability setup. The discount on this liability would then be unwound up over the period until the costs are paid. This means the liability increases by the interest rate each year, and this increase is taken to the P&L. I think this is going to make very sense to you when we deal with an example, but let me just try to put this into context so that you can understand what we are talking about here. So you acquire what we call, for example, an oil rig, okay? You acquire an asset that needs to be dismantled at the end of its useful life. You elect a tower, okay? You elect a tower somewhere, and then they tell you to say, after 20 years, you have to dismantle this tower, or after 20 years, you need to dismantle this oil rig from the ocean, okay? And then at that particular time, you have to calculate the cost of dismantling that particular asset. the cost of dismantling that particular asset should be part of your cost today, the cost that you are going to recognize the asset. Okay, so what now you have to do, remember I talked about some present value at some time back. So what you're now going to do is this. You are going to estimate the cost of dismantling, say in 20 years. But remember, you need to factor in the time value of money here. So now what you're going to say is, what would be 20 million kwacha, if that is the cost of dismantling? What would 20 million kwacha cost us in today's money? So you calculate the present values. And that's the formula. Their present value is equal to 1 plus R over negative N. Okay, so where N is the discount factor present, where N is the number of years, and R in that equation is the interest rate, and PV is the present value. So that's the formula that we are going to use to calculate a question that has to do with dismantling costs. So all these costs that I've talked about added together is what you are going to recognize in the statement of financial position as the cost of an asset of property, plant, and equipment. I guess I've addressed some of the pertinent issues there. Then now let's talk about subsequent expenditures. Sorry. So let's talk about subsequent expenditure. So I did tackle on subsequent expenditures a bit when I was talking about a motor vehicle. All right. So now subsequent expenditure on property, plant, and equipment must only be capitalized if it meets the following criteria. Subsequent expenditure must only be capitalized if it meets the following criteria. Let me pause here again. When I talk about capitalizing something, I'm saying it should be taken to the statement of financial position. So if a transaction is recorded in the statement of financial position, then it has been capitalized. But if a transaction has been recorded in the income statement or a statement of profit or loss and other comprehensive income, then that has been expensed. If it goes to the P&L, it has been expensed. If it goes to the balance sheet, it has been capitalized. So those are the differences there. All right. So that is the criteria. Number one, it enhances the economic benefit provided by the asset, e.g. expansion, increase in productivity, or increase in useful life. Let me give you an example. So if I buy this laptop is, say, it has the memory of this laptop or the hard drive on this laptop, which is the major component of this particular asset, is as memory of, say, 500 GB, 500 gigabytes. That is the laptop. But now looking at the use of this particular laptop in our company, we realized to say, you know what, to increase revenue, all right, for us to be efficient and make sure that we record more revenue, I think we need to change the hard drive of this laptop. Okay, so the speed at which the laptop is running at, I think it is slow. Number two, because of that slowness, I mean, because of this, the size in the memory that is has, it's causing the laptop to be slow. So what then we can do is, okay, I think let's buy a 1 terabyte hard drive and put it in that laptop. So now what we have done is we've added economic value to that particular asset. It's going to be fast, and then we are going to process more entries, okay? So the cost of adding the 1 terabyte hard drive should be capitalized and not expensed, because the hard drive is a major component of this particular laptop. Same as a motor vehicle, okay? Same as a motor vehicle. If you replace, for example, an engine of a motor vehicle, you must capitalize the cost of the engine. I've explained that. So you need to take that assessment in order for you to determine whether this expenditure must be expensed or this expenditure must be capitalized. It must relate to an overall or required major inspection. Costs related to this must be capitalized and depreciated over the time until the next overhaul or inspection is done. So, this relates to, assets that have got, complex assets, for example. We've got complex assets. So when you talk about a plane, okay, when you talk about an aeroplane, a plane has different components. So when you look at a plane, the life of a plane, you would find that certain components of the plane will wear out easily and earlier than other components. For example, the entire body of a plane will have a different useful life. The interior of the plane will also have a different useful life. So you've got chairs there, you've got the bathroom, toilet, and all those stuff there, and other machineries that may be there. So those components wear out earlier than the body of a plane. Okay. Again, you find that the engine as well has got its own useful life. So the standard guides us to say, okay, for these assets having, this complex asset, each component must be, you must determine the useful life separately and depreciate them as such. Okay, that's what it is. Then, going back to overall costs. If, for example, you're taking a motor vehicle for servicing, that cost of servicing is a regular, it's a regular cost just for your car to be to work well and to try and amend some of those wear and tears that are happening to your vehicle. So in normal circumstances, such a thing should be expensed. But when you're talking about a complex assets like aeroplanes, you have to do they have to do what is called an overhaul, expenditure, where they, for example, have to change the entire seats in a plane. So that expenditure has to be capitalized. Okay. Then inspection costs as well. So inspection costs, you might think, no, inspection costs for an aeroplane must be expensed, but the standard has allowed us to actually capitalize those expenditures. Okay. Subsequent expenditure, which is revenue in nature, must be expensed to the P&L, and as they only help maintain expected economic benefit of an asset. So that is the footnote there. If a subsequent expenditure is revenue in nature, you must expense it because it only maintains expected economic benefit of an asset. All right, so now let's look at subsequent measurement. So I'm going to talk about the subsequent measurement in my next video. Okay, so follow me as I talk about subsequent measurement in the next video. I hope I have addressed some of the pertinent issues that have to do with initial recognition of an asset and its subsequent expenditure. Follow me on YouTube. I'm going to post another video on subsequent measurement where we are going to talk about revaluation of an asset. Thank you very much, and may God bless you.